Federal law draws a sharp legal distinction between two payment cards that most people believe offer the same protection. Under Title 15 of the U.S. Code, Section 1643, the maximum amount you can be held responsible for if your credit card is stolen is $50. Any additional fraudulent charges are generally the responsibility of the card issuer. Now take the debit card sitting beside it in your wallet. It may display the same Visa or MasterCard logo, look nearly identical, and even come from the same bank, but it operates under an entirely different legal framework. Debit cards are primarily governed by the Electronic Fund Transfer Act of 1978, and the protections depend heavily on how quickly you report unauthorized activity. If you fail to notify your bank within the required time limits, your potential losses can increase dramatically. In some situations, unauthorized transactions may affect not only the money in your checking account, but also linked savings accounts or overdraft protection tied to that debit card. To most consumers, these two cards appear interchangeable. They share the same network logos, fit in the same wallet, and are accepted by the same merchants. Yet behind the scenes, the legal protections they provide are fundamentally different, and understanding that difference can make an enormous impact if your card is ever lost or stolen. They slide into the exact same point of sale terminals at the grocery store. The cashier asks you if you want to run it as credit or debit, and it feels like a simple choice of preference. It is not. It is a choice of legal jurisdiction. When you make that choice, you are deciding whether you are protected by the consumer safety nets of the 1960s or the deeply flawed banking compromises of the 1970s. In 1968, Congress looked at the rapidly expanding credit card market and realized that consumers needed a permanent safety net. They passed the Truth in Lending Act, implemented by the Federal Reserve under Regulation Z. The logic was simple. A credit card represents the bank's money. When a criminal steals your credit card number, they are taking an unsecured loan from a massive financial institution. The bank has whole departments of highly paid fraud investigators, former federal agents, and sophisticated algorithms designed to track and recover corporate funds. The law capped your liability at $50 because you are merely a bystander to a crime committed against the bank. The bank is highly motivated to stop the fraud because every dollar stolen directly impacts their quarterly earnings. 10 years later, the world changed. The automated teller machine was introduced. Point-of-sale terminals began appearing in retail stores. Congress needed a new set of rules for this electronic money. So, they passed the Electronic Fund Transfer Act of 1978, implemented by Regulation E. But a debit card does not use the bank's money. A debit card uses your money. When a criminal steals your debit card, they are taking your actual cash. The bank acts as a reluctant custodian. They are legally required to investigate, but their obligation is purely procedural. The money lost does not belong to their shareholders. It belongs to you. The 1978 rules were written for a physical world. They were designed for a time when you carried a piece of plastic in your purse, and if your purse was stolen, you noticed it was gone. You walked into your local bank branch the very next morning. You sat down with a teller you knew by name, and you reported the theft. The laws assumed you would know you were a victim. Today, criminals do not need to steal your physical card. They buy your card number on the dark web. They install Bluetooth skimmers inside the gas pump. The card never leaves your wallet. You have no idea the crime has occurred until your actual cash is gone. Consider Margaret. Margaret is 71 years old. She lives in Oak Park, Illinois. She and her husband Thomas bought a 3-bedroom brick bungalow in 1988 for $142,000. Thomas passed away 3 years ago. Margaret manages her own affairs now. She is careful. She balances her checkbook. She keeps her doors locked. She ignores strange emails. She has a primary checking account at a major national bank. She keeps $14,000 in that account. That money is designated for her property taxes, her Medicare supplemental premiums, and emergencies. It is a Tuesday morning in late October. She drives to the local gas station on the corner. She inserts her debit card into the pump. The pump has been tampered with. A microscopic shim thinner than a piece of paper has been inserted directly into the card reader. It reads the magnetic stripe and records her personal identification number. For 12 days, nothing happens. Professional criminals do not strike immediately. They wait. They bundle the stolen numbers and sell them in bulk to overseas syndicates. On the 13th day, a test charge appears on Margaret's checking account. $112 at a convenience store in another state. The criminals are testing the card to ensure the account is active and the bank's security software is not triggered. Margaret does not see this charge. She does not use mobile banking applications. She waits for her paper statements to arrive by mail. 2 days later, the real theft begins. A charge for $400 at an electronics retailer. Another charge for $600 for online gift cards. A transfer of $800 to an offshore payment processor. Over the course of 3 weeks, the criminals systematically drain $8,400 from her checking account. The transactions are processed silently in the background while Margaret tends to her garden and visits her grandchildren. Her statement cuts on the 15th of the month. It is processed, printed, and mailed. It arrives in her mailbox on the 20th. She sits down at her kitchen table on a Sunday afternoon to review her expenses. She traces her finger down the column of numbers. She sees the pharmacy. She sees the grocery store. Then she sees the electronics retailer. She feels a cold, sudden panic in her chest. The numbers blur on the page. She picks up the phone and calls the customer service number on the back of her card. She navigates an automated phone tree for 10 minutes before she reaches a human being. The representative on the other end of the line is polite but entirely detached. Margaret explains the theft. She expects the bank to restore her funds immediately to recognize the obvious fraud and fix it. Instead, the representative reads from a mandated script. They tell her they will open a fraud investigation. Under Regulation E, specifically Section 1 and 5.11, the bank has 10 business days to investigate before they are required to issue provisional credit. 10 business days is 2 full calendar weeks. For 2 weeks, Margaret is missing $8,400 of her own money. 2 days after the phone call, her property tax check bounces. The county assesses a penalty fee. Her automatic payment for her electricity bill fails. Her account is frozen while the investigation proceeds. She has to borrow money from her daughter just to buy groceries. She is entirely paralyzed waiting on a bank investigator who views her life savings as just another digital file in a stack of thousands. And Margaret is actually one of the lucky ones because Margaret opened her mail on time. Let me explain exactly what happens to the seniors who do not open their mail on time. The specific law governing this exact scenario is Title 12 of the Code of Federal Regulations, Part 105, specifically Section 105.6. It outlines the liability of a consumer for unauthorized transfers. It is the most punitive piece of banking regulation facing seniors today. It establishes 3 distinct tiers of financial liability. It is a ticking clock designed to shift the burden of fraud from the massive financial institution directly onto your shoulders. Tier 1 is the 2-day rule. If you realize your card or your card number has been compromised and you notify the bank within 2 business days, your maximum liability is $50. That sounds entirely reasonable, but remember the modern reality of fraud. How can you report a theft within 2 days if the card is sitting securely in your wallet and you have no idea the number was skimmed at a gas station 2 weeks ago? You cannot. You are almost never going to meet the requirements for Tier 1 unless your physical purse is stolen out of your hands in broad daylight. Tier 2 is the 60-day rule. If you fail to notify the bank within 2 business days, your liability automatically jumps to $500. $500 of your own money gone legally. The bank is not required to reimburse that first $500. They will take it from your account, point to the federal code, and shrug their shoulders. This tier applies if you catch the fraud and report it within 60 calendar days of the bank transmitting the periodic statement that contains the first unauthorized charge. Then we reach Tier 3, the disaster tier, the rule that bankrupts retirees and destroys financial security overnight. If you do not report the unauthorized transfer within 60 calendar days of the bank transmitting your statement, your liability becomes entirely unlimited. The bank is absolved of all responsibility. You lose every single dollar stolen after that 60-day mark. You lose your entire checking account balance. If your checking account is linked to your savings account for overdraft protection, the criminals will drain the checking account and the bank will automatically pull funds from your savings account to cover the continuing fraudulent charges. They will drain your savings too. The law protects the bank. It does not protect you. Notice the exact legal phrasing I used. 60 days from the date the bank transmits the statement. Not the date you receive it, not the date you open it, not the date you understand it, the date the bank puts it in the mail or sends the digital notification. The clock starts ticking the moment it leaves their system. What if you are in the hospital recovering from hip surgery? What if you travel to Florida for the winter and your mail forwarding is delayed by the postal service? What if your spouse passes away and you let the mail pile up on the dining room table for 2 months while you grieve? The law does include a tiny, fragile provision for extenuating circumstances. Section 105.6, subsection B, paragraph 4. It states the time limit shall be extended to a reasonable period, but banks fight this aggressively. They demand medical records. They demand proof of travel. They force you into a grueling appeals process requiring notarized affidavit and legal documentation. All while your money is completely gone and your bills are piling up. Most seniors simply give up. I am Walter Barron. I spent 30 years watching financial institutions build systems that extract wealth from ordinary people while hiding behind impenetrable walls of compliance and regulation. I started this work because I was tired of watching honest people lose their security to technicalities they never knew existed. I have no products to sell you. I have no courses. I am here to tell you the things your bank hopes you never learn. Let us run the exact math on a realistic scenario. I want you to see the numbers clearly. I want you to understand how quickly a minor data breach becomes a catastrophic financial loss. Imagine a retired teacher named Harold. Harold has $22,000 in his checking account. He recently sold a classic car and deposited the funds. On May 1st, his debit card number is compromised by a hacker who breached a hotel reservation database. On May 10th, the hacker makes a single unauthorized test charge of $20 to a fake online charity. Harold's bank transmits his monthly statement on May 15th. The statement includes that $20 charge. Harold receives the statement on May 20th. He misses the $20 charge. It is buried on page 3 between a trip to the hardware store and a grocery receipt. He files the statement in his cabinet and goes about his life. The 60-day clock started on May 15th. It will expire on July 14th. Through June and early July, the hacker does nothing. They are waiting. They know how the banking system works better than the consumers do. They wait for the legal liability to shift. On July 20th, 6 days after Harold's legal protection has expired, the hacker strikes. They run a series of massive wire transfers and international debit purchases. In 48 hours, they steal $19,000. Harold goes to the ATM on July 25th to withdraw cash. The machine declines his card. He goes inside and speaks to the branch manager. He discovers the fraud. He demands his money back under federal law. He assumes he is protected because he reported the massive theft within 5 days of it happening. The branch manager pulls up his account. The manager looks at the dates. The manager informs Harold of the exact text of Regulation E. Because Harold failed to report the initial $20 fraud within 60 days of the May 15th statement transmit, he has forfeited his protection for any unauthorized transfers that occurred after the deadline. Let us calculate Harold's liability. For the $20 taken before the deadline, his liability is capped at $500. He loses the $20. For the $19,000 taken after the deadline, his liability is unlimited. The bank is not required to refund a single penny. Harold loses $19,020 permanently. The bank finishes its investigation, and Harold loses nearly all of his retirement savings because he overlooked a single $20 fraudulent charge that appeared on an earlier statement. Now imagine the exact same situation, but this time Harold paid with a credit card instead of a debit card. The hotel suffers the same data breach. The hacker makes a $20 test purchase, then later charges $19,000. Harold notices the fraud weeks later and contacts the credit card company. Under the Truth in Lending Act and Regulation Z, his maximum legal liability for unauthorized credit card charges is generally limited to $50. During the investigation, he can dispute the charges, and his own cash remains untouched. His checking account and retirement savings stay safe while the credit card company handles the fraud. Two cards may look identical in your wallet, but they offer very different levels of protection. This happens far more often than many people realize. The Federal Trade Commission reports billions of dollars in fraud losses every year, with bank transfers and payment scams accounting for a large share. Criminals frequently target older Americans because they often have larger savings and are more likely to rely on paper statements, giving fraudsters more time before suspicious activity is discovered. Banks continue promoting debit cards because they are highly profitable. Every purchase generates transaction fees for the bank, while much of the financial risk remains with the customer. Credit cards, on the other hand, place much more of that risk on the card issuer. Another danger is overdraft protection. Many banks present it as a helpful service, but it can automatically connect your checking account to your savings. If criminals drain your checking account through debit card fraud, the bank may automatically transfer money from your savings to cover those transactions. Instead of limiting the damage, overdraft protection can allow fraud to spread from one account to your entire cash reserve. Understanding these differences can help protect the savings you've spent years building. If overdraft protection links your savings account to your checking account, fraudulent debit card purchases can trigger automatic transfers from your savings. Instead of stopping the fraud, the bank may move your own money to cover the charges, turning a small breach into a much larger financial loss. Another common risk involves recurring payments. Many seniors keep their debit cards on file for utilities, streaming services, insurance, and online shopping. If one of those companies experiences a data breach, criminals can obtain your card number and make small transactions that often blend in with normal monthly bills. If those unauthorized charges are not reported within the required time under Regulation E, recovering the money becomes much more difficult. The safest approach is to reduce direct access to your bank account. First, stop using your debit card for everyday purchases. Reserve it for withdrawing cash from your bank's own ATM or inside a branch whenever possible. Second, use a no annual fee credit card for groceries, gas, pharmacies, and other daily expenses. Credit cards generally provide stronger fraud protections because criminals are using the bank's money, not yours. Just be sure to pay the balance in full every month. Third, if you do not use credit cards, ask your bank to disable overdraft protection that connects your checking and savings accounts. A declined transaction is far less damaging than allowing fraud to drain multiple accounts. Finally, review all automatic payments. If possible, move recurring charges from your debit card to a credit card. If payments must come directly from a bank account, consider using a separate checking account that holds only enough money to cover monthly bills, keeping your primary savings isolated. These steps take only a couple of hours, but can significantly reduce your financial risk. Debit cards and credit cards may look almost identical, yet they offer very different levels of protection. Understanding that difference can help safeguard the savings you've spent decades building. If this report was helpful, subscribe to the channel so you don't miss future updates. Leave your state in the comments so I can cover the rules affecting your area, and remember to review your bank statements regularly. Disclaimer: this video is for educational purposes only and should not be considered financial, legal, or tax advice. Always consult a qualified professional regarding your individual circumstances.